Your host, Josh Appleman, founder and CEO of Appleman Properties. Today we are joined with Tariq Sattar. Tariq is the CEO of Anthem Capital Partners, has a decade of consulting and 20-year real estate career, transitioning from 55 homes to 22,000 plus units, holds an MS and an MBA. Tariq, we're excited to have you with us today. If you could let the listeners know a little bit more about yourself.
Thanks, Josh. Good to be here. Thanks for having me. You covered highlights of the background. I was in the corporate world for a number of years after my MBA, initially in consulting and then in restructuring and crisis management. Traveled the world, worked in a lot of different countries, in a lot of different industries, and then was actually in Europe when living in Europe for a number of years before we decided to move back to the US and ended up in Oklahoma. Give credit to my wife to keep pushing me to explore real estate as an option. She always wanted me to buy one single family home as an investment, and she kept badgering me enough that I started actually looking into it, started reading up on it. Arranged a handful of meetings with investors that had been doing it for a number of years and had a pretty significant sized portfolio, and ended up starting down this path. And in just a quick 2 years, I had pulled together 55 single family homes,
Wow.
and realized quickly that it's going to be very difficult to continue to scale in that, and started looking at commercial avenues and narrowed it down to a handful of commercial property lines, and started out in multifamily and have been very active in that now for a number of years.
At what point in your career did you make a shift into real estate, and then so you were doing consulting for a number of years, and then there was a transitioning period to where you
Right.
transit.
So I left the corporate world, and I was doing some independent consulting and a lot of stock market investments. And that is, what I was doing for a number of years before started down the path of real estate. So I had actually stepped out of the corporate world for a number of years before started the journey into real estate.
Got it. I'm assuming that you were very successful in that part of your career, and then that transitioned over to enable you to start investing into single family houses.
Right. So what helped me, go pretty quickly at it was the fact that I had a decent amount of capital to start with, and the way I was going about it was, buying properties with cash, taking them through the rehab process, then handing them over to the property management company to find a tenant for them, and starting the refinancing process at that point. And my goal was to, not have more than a few $1,000s per property invested of my own capital once I go through the refinancing. And across the 55 house portfolio, I had about $5,000 a home of my own capital invested, and I was able to do that only because I was, buying them with cash initially, and rehabbing them, and then taking them to the refinancing process.
Yeah, and that's tough. Purchasing the house and then getting it remodeled, and then going through the renovation process, the contractor, the procuring the labor and the material, full cycle. That there's a depending on how heavy of a renovation you're going, it could be light cosmetic, or you could be moving plumbing stacks and adding bathrooms, adding bedrooms. I mean, were you all looking for more turnkey renovations, or was it deeper value add?
Not necessarily deeper value add. There were maybe a half a dozen out of the 55 that were major investment in terms of the rehab dollars, but those also were, rather were bought at a rather low price.
Got
So
it.
that is how I was able to support that, and make the numbers work. But most of these were maybe somewhere between 20 and 40% of the purchase price is what was
Yeah.
being put into them for rehab dollars.
Yeah. Yeah. That's the golden rule. Buying right, make your money on the buy. And it's hard to find
Right.
those properties, but you got to be patient and willing to wait and pass up the others.
Right. And you know, the reason I started exploring other avenues was because it was getting tougher and tougher
Yeah.
to find a good deal. Um, we hear a lot of chatter and discussion about fix and flip, and a lot of people trying to do that. And of all the 55 homes that I bought, I assessed every single one of them as a flip opportunity, and there were three of them that really were good candidates for it, that I was able to really do a good amount of rehab and then turn around and sell them. None of the others were really good candidates for it. It is very difficult to find a good fix and flip kind of an opportunity as well.
Yeah. Yeah. The right vintage, right area, right location to where you have home buyers versus renters. And there's a lot of factors. I get it. So we went from 55 houses to now we're exploring commercial. Can you tell us what that looked like, the introduction to commercial, and then how you came across your first property and the size?
Right. So started looking at other avenues to scale up and grow at a faster pace, and started assessing, evaluating all the commercial real estate options. Um, Narrowed it down to multifamily, self storage, and senior housing were the three areas that I narrowed it down to, and then started digging further into those. um, Narrowed it further down to just self storage and multifamily. And it just so happened that we started down the path of multifamily before self storage. I do a lot of passive investing as well, with other GPs and sponsors, and I have several investments in self storage facilities as well, but only as a passive. We have never syndicated or sponsored a self storage acquisition. I started out with just investing passively into a couple of multifamily acquisitions in the Dallas Fort Worth area. I live in Oklahoma City myself, just about a 3.5 hours drive north of Dallas. The Dallas Metroplex has been growing significantly over a number of years. So I started out as just a passive investor in a couple of acquisitions, multifamily acquisitions, value add, 70s vintage, 150, 200 unit size range. Um, had the opportunity to become a KP or a key principal in one of those two, and that was the underlying goal. There was to have the qualification of having been a signatory or a guarantor to a Fannie Mae loan, one of the agency loans. So did that, and then being in Oklahoma, started essentially looking at Oklahoma City initially, and we purchased probably about a year and a half after starting investing as a passive investor in multifamily. We picked up a three property portfolio, a total of 214 units across three properties in Oklahoma City. So that was the first one that we purchased, that we syndicated.
On that first purchase, did you join with another group, or did you form your own general partnership group?
Right. So we started out, when we started our journey in the multifamily space. We started with Anthem as the underlying company that was doing that. Ivan Vian and myself are the two founding partners of that. Ivan is here in Oklahoma as well. Retired recently from the U.S. Air Force as a pilot. He was there for a few decades, and his our paths crossed as we were both investing in single family space. He was still working in the Air Force. I was looking to buy a single family. That is where we met, and worked together in the single family space for a number of years. and then started exploring multifamily together. So he has been my co-GP in all of the syndications that we have done. But we have also, in addition to the just the two of us, we have had typically one to two other co-GPs with us. Underlying reason just could be net worth liquidity requirements from the lender, as well as helping us raise the equity.
Got it. Got it. So you'll have you'll have parts of the general partnership ownership split amongst the GP team on what their roles and duties are. Um, what has been what's been one of the biggest learning lessons that you've had so far doing syndications?
Um, well, it's and this has become a lot more critical and a lot more important as we go through the current cycle of the industry that we're going through now, the property management of it.
Yeah.
The You have so many different partners that you're working with. You have brokers, you have attorneys, you have lenders, insurance providers, and property management companies, other just contractors. So many different people that you're working with very closely. A vast majority of them drop off as soon as that deal closes, and you sign on the dotted line.
Yeah.
Then it is you and the property management company that are left to just manage it from that point on. The property management, and that, not having the right partner in the property management company, and not having the right staffing at the property management company, at your property within the property management company, that's going to break it very quickly. We have learned it the hard way. We have had um, several different properties where we have had to switch property management companies midstream, which is not an easy thing to do in itself. But we have had to do it. And um, so that really has been, the hard lesson has been to really invest time, effort, energy into finding the right partner who is going to be the one that is going to manage the property on your behalf, on your investors' behalf.
Yeah, that's the you hit the nail on the head because we manage our own properties now, and that's a blessing and a curse because it can keep you completely inundated in the weeds to where you can't focus on new acquisitions because you're focused on performance of the properties, which is asset management on one end, but you're also propping up the property and you have the daily grind. But to accelerate a portfolio, you have to leverage third party property management as well. And if they're just hiring people to put warm bodies in seats, it hurts the property overall, and then you're back to being in the weeds to basically managing the property on a different management point. It's extremely tough. The labor market is extremely tough, and your property management is making or breaking the property. Um, you have a thousand units under management. Are you all using, and then 22,000 units as passively? Are you all utilizing all third party on the thousand units?
We are utilizing a third-party property management company across our holdings. Over the years, since Ivan and I both started down the path of multifamily, we have acquired 20 assets in a half a dozen different states. 14 of those have gone full cycle. So we have 6 assets in our portfolio currently. Um, we have always managed them through third-party property management companies. Um, Between Ivan and myself, I handle, primarily the acquisition, disposition, refinancing side of things, dealing with working with the brokers, the lenders, the attorneys. That is in my sphere. Work very closely with Ivan as we are going through the underwriting and then the budget development process with the property management company. But once we are closed on the acquisition, then Ivan really is the point person on the asset management side, and he is the one that goes out to the properties on a frequent basis, visits the properties. We have weekly calls with the on-site management staff and the property management company on every single one of our assets every week.
Nice.
And we will transition to maybe a bi-weekly call. Once we are a year or two into it, we have gone through the repositioning, the retenanting of the property, and it's stabilized at this point. That is when we would reduce that frequency. Otherwise, we are very closely monitoring a lot of key metrics on an ongoing basis.
Yeah, making sure that the rents are being maximized to market rate, which in good turn, because you're putting so much money into unit renovations, making the amenities better, the management better, just better place to live for the tenants, and end up getting rents where they need to be. What has been one of the biggest challenge properties that you've had, and what were some of the challenges?
Biggest challenge properties. There have been a few. You know, there. The very first one of our acquisitions was a three-property portfolio. One of those was in a market where there was a lot of new supply that came online within a year of our acquisition. We took it through a significant investment and rehab, improvement of the units, but then with the new supply coming online and the concessions and the efforts on their part to um, get the occupancy up on those properties really impacted rent growth. We actually suffered in that particular market, in that particular sub-market, we suffered a couple of years of negative rent growth. And that made it very difficult to try to grow NOI. And those, ended up being a couple of properties that did not perform as well. The returns on those were not uh, close to what we had projected going in. Um, Other than that, we have had issues just having a boiler chiller asset
Yeah.
and older boiler chiller asset that we had in DFW market, and issues that some of the older mechanics can do mechanicals, and those plumbing mechanicals, those issues were just rampant on that property. um, had to put in a lot of money, had to just reallocate the funds that we were going to put into improving the units, had to reallocate those to try to improve the mechanicals in the backbone, which does not necessarily help you improve the rents, improve the income, but it does help you to keep the property occupied.
Yeah.
So those are necessary bones that you have to have on the back end. So those have been a couple of difficult ones. We have acquired properties with bank loans, full recourse bank loans, where the occupancy was low, or we acquired a property in North Little Rock where 20% of the units had been offline for more than a decade.
Wow.
A couple of buildings were just roped off because there were some foundation issues. We bought that property with a bank loan, and it took a fair bit of work to bring all those units back online. We had to do a lot of capex on replacing the roof on the entire property. That was a 200 plus unit property. And then bringing all of those 20%, about 40 plus units that had been down for a number of years, for over a decade, and bringing all of them back online. And then we were able to, about 2.5 years into it, we were able to refinance that to an agency loan, because we
Nice.
had really improved the collections, had the occupancy was in the mid 90s, and then we held on to it for a couple of more years, let it cash flow, and then we sold it, and sold it at more than double the per unit price that we had purchased it for. So it was
That's
difficult taking it through that process, but we had a plan, and we had a good team in place to execute the plan, and as difficult as it was going through it, we went in with a plan and were able to execute it and deliver.
that's delayed gratification. That's real estate at its finest. So on the capex and renovations, is the third party property management company, are they managing those on your all's behalf, and then you're managing them?
Um, it has varied. It has varied from property management company to property management company. Um, and in some of them, we would typically have a co-GP with us that is local to the submarket or the market where the property is. Currently, Ivan and I both the lead, GPs in any of the acquisitions that we do as GPs. We are in Oklahoma. We don't. We At one point we owned 6 properties in Oklahoma. We do not own any in Oklahoma currently. But wherever we syndicate as GPs, we have a co-GP that is local to that market, is experienced, and is one that is typically on site at the property on a very frequent basis. Very involved with the rehab process, walking to the point of walking the units with the contractor, agreeing on the scope of the work, and then walking the units on the back end when the work has been done to make sure the work has been done as per the scope and it is
Nice.
really rent ready. So, and there has been one instance where we have a property in our portfolio where we do not have a co-GP that is local to the market, but what we did in that case was we actually hired someone as our representative to fill that role, and he was there representing us on our behalf, working with the contractor on an ongoing basis, ensuring that what is being done is, the scope is in line with what we want to do, and the cost is in line with what we want to spend. So, um, yeah, I mean, the property management company is involved to some degree, but we are not hands off. We are very much hands on in that process. Um, and there are, a couple of instances where we have bifurcated the ongoing OPEX and CAPEX, where OPEX is being managed and spent by the property management company from the operating account, but the CAPEX, we have a separate team that manages the um, invoices and the payments and the CAPEX,
Yeah,
and a separate CPA that handles all that. So, where appropriate, we bifurcate that and manage it separately.
that's perfect. And I'm just asking for nuggets here, because it can be cumbersome when you have multiple properties, multiple units. Just call it say even 200 units out there being renovated at any given time. You've got labor and material incoming and outgoing, so keeping it all managed, quality control in place, and making sure that you are truly getting what you're paying for. Just checks and balances, internal controls. It's a part of the operation, and it's a huge part of it. And then being able to scale like you all have, it's utilizing the right people and the right pillars of each company.
Right, and those, we have learned a lot of lessons the hard way, have made mistakes along the way, and you know, property management company, they have a lot of opportunity to tinker with the funds and make payments. We make payments from your account for expenses of another property.
Oh
We
yeah,
have caught that more than once. Just making payments for work that was never done. Making payments for deliveries, for equipment, for deliveries, for parts that were never received. So, and then things, appliances, things could show up and be put in storage and then walk away.
yeah,
So, those things happen, but you try to control that, as much as you can, but there's only so much you can do, and you have to rely to some degree on the property management company and the staff that is there on site. Um, and at the end of the day, you just got to have the right team in place, and as long as you have that, you'll be able to minimize the impact, the losses that might happen from those kinds of instances. And you have to be able to the extent something like that happens, you have to have the processes and the checks and balances in place to catch that quickly.
Yeah, that was one of the leading factors of why we wanted to take property management in house. Is we felt like expenses were being mismanaged and money was just getting thrown at a band aid for the true problem instead of getting fixed at even a lower cost and getting the root of the issue taken care of, and plus just managing the property at its fullest extent to where our residents, our customers are happy and they're getting things taken care of in a quickly basis. You just you want to put your trust out there, but if you don't have an alignment of interest, a vested interest from property management, it makes it tough. It makes it tough to have an alignment. Then you put checks and balances in place, like you all have, boots on the ground. You're all's representative to make sure, in fact, you are getting what you're supposed to be getting. I think that's huge. That's a great way to scale and a great nugget, especially working outside of where you all reside. You can't drive to these properties in a half an hour, 45 minutes. You have to rely on other people to carry out the asks that you need. So that's huge. Um, if you had to start over, what would you? How would you get started? What would you do?
I mean, starting over, having had discussions with a lot of people over the years that are considering real estate as an avenue to invest. I always get asked if there is a benefit to going into the single family space initially, or should one just go into commercial, into multifamily, if that is the space that one wants to get into. And it's yeah, it may help you get your head around the whole process, but multifamily is very different, especially if you are looking to invest passively, right? That is very hands off. If you are looking to be a GP, a lead sponsor in acquisitions, that is different. There is a lot of responsibility that comes with that. But for if you are looking to just deploy capital as a passive investor, then that I don't see any benefit to going through and doing single family initially. A lot of people go through that process, that those steps, because it's the scale of multifamily just seems too big, right? Going instead of buying a single family home for a couple of $100,000, you're looking at you know we don't look at properties less than 70, 80 units at least. So we're looking at tens of millions of dollars, and you're looking at loans that you're taking on for a 20 million asset. You could be taking on a loan of 12, 14 million dollars. And it's the great thing about multifamily is that you have the agencies, the Fannie and Freddie loans that are available, and those are non-recourse loans. There are bridge loans that are non-recourse as well, but the Fannie and Freddie, that's the gold standard. If a property qualifies for that financing, and you are able to get good leverage from them, they have very good products on the small balance loan on relatively smaller acquisitions, and we have done several of those, and just the conventional loan, both fixed and floating, with various different maturities. And the great thing is they're non-recourse. The recourse that the lender has is the property itself. You're not personally guaranteeing the loan.
Yeah,
Now, if you go the way of a credit union loan or a bank loan, we have done both. We have done plenty of in both of those categories, and there is a recourse component. There could be banks might want a full recourse. Credit unions may do a 50% recourse. But it just getting your head around the scale that you're looking at in multifamily, but it's very much doable. It's never in our wildest dreams we would have thought that we would acquire real estate valued in hundreds of millions of dollars, and we would raise equity in we have raised, I think, 75, 80 million dollars of equity for those acquisitions over the years. Never would we have thought that that is realistic, but it is. Just getting educated on the space itself, and then really understanding the underlying mechanics of the underlying components of the underwriting, the analysis of a property, and the market, the sub market that the property sits in. Getting your arms around it, spending time on that, understanding those things, it could make it much, much, much easier and doable than one could imagine going into it.
That's huge. Yeah. How would you recommend a beginner real estate investor wanting to get into the space? What path do you recommend that they go?
Right. So, it's good to get educated. There are, plenty of books, plenty of programs out there these days. Some of them online, some of them in person, some of them just, books. Just get educated on the space, and um, you know, try to understand the underwriting, the analysis, the valuation, the various components, the various key components that impact the value of the property and the underwriting. Understanding that, and then what I did initially was, which to me was the right thing to do, to go in and start out as a passive investor. Start evaluating opportunities, investment opportunities, understanding the market that the property sits in, understanding the underlying economics and the dynamics of that market, really getting to know who the sponsors are, what their track record is, how they have underwritten it, what kind of financing they're getting. At the end of the day, when I'm looking to make an investment decision, it about for my money, as a passive investor, it's my money. I am the one who should do the most amount of spend the most amount of time, effort, energy in making sure that I hand it over to the right person for the right opportunity. So do that homework. Don't just believe in what is presented to you in a good looking presentation. Dig into the numbers, understand the analysis, the underwriting, the assumptions, and learn the ropes that way. Do an investment or two as a passive investor, and then see if you want to grow towards the being a lead GP, being a co-GP, and a syndicator, or just continue deploying assets, deploying capital as a passive investor.
Awesome. Where do you feel the market's heading, and then the lending as well?
I mean, with the with the CPI report coming out this morning, slightly hotter than what was projected and expected. I think the interest rates stay high for maybe through the rest of this year, and maybe we hopefully they don't. Hopefully, the Federal Reserve doesn't you know push them higher another 25 basis points towards the end of the year. But a lot of that would depend on the data that comes out between now and then. But medium term, at some point next year, first half of next year, the Federal Reserve is going to reverse course, and the interest rates are going to trend down in the residential, both single family and commercial multifamily space. There is a huge disconnect in supply and demand. The supply isn't there. The demand has gone up. Right now, in the single family space, there the number of listings, the number of transactions are very low. In the multifamily, one of the metrics that we look at is the affordability gap, meaning the gap between the monthly mortgage payment and the monthly rent payment. So the monthly mortgage payment on average has crossed 1,000. I think it's 1,100, $1,200 more on average in the US compared to a rental payment. So it makes it that much more difficult for someone to own a home. And it's going to just in 25, 26 time frame, going to put a lot more upward pressure on rents just because of the demand, because of the affordability gap.
Yeah.
So I think it's going to go the multifamily space is going to stay strong, especially in, we always focus on markets that are growth markets where there's a net positive migration both for employers and employees. There's just population growth and with strong underlying fundamentals. And then we focus on markets that are landlord friendly. So as long as you are investing in markets with those characteristics, the next several years, the next 18 months are still tough, but there are going to be good deals, good opportunities to invest in to be had in these next 12 to 18 months. But the next 3, 4, 5 years after that are expected to be very, very strong years, especially in the multifamily space.
Yeah, you can. It's everything's on discount right now to some degree, but it's on discount. Can be on a buy price, but you're still paying for it on the interest. So underwrite a 3 to 5 year refinance or exit. Might there might be some pretty good light at the end of the tunnel, or hold it forever, hold it for 10 years or whatnot. I know agency loans are usually 10 year. You've got your 10 year terms, and it can be assumable, and it amortizes over. You can get up to 40 year amortization on some of these lenders, which kicks off a lot more cash flow. One more question: what's been the best piece of advice that you've received during your career?
Start real estate.
Yeah,
It's,
yeah,
it could be very daunting if you really have not done it. The only experience in the real estate space that I had was, the which is typical is either buying or renting. I used to rent starting out, when I was a student, on the East Coast, and then rented the first condo that I was living in. Once I started working, bought a condo, bought a home, bought moved and bought a second home. But that was it. Renting or buying your primary residence is typically the real estate experience that one has, and working with pretty large numbers. Those are some of the biggest purchases. One of the biggest purchases that you're going to make in your life. So it could be very daunting, but it's it's if you have a longer term investment time horizon, um, real estate will definitely make you a lot of money. It won't do it in short term, but it will do it for sure in long term.
yeah. I totally agree, 100%. If somebody wants to get a hold of you, whether they want to invest with you all, learn from you, just ask a general question, how can they look you up and get a hold of you?
Easiest thing to do would be to go to our website, anthemcp.com, short for Anthem Capital Partners. So anthemcp.com. My email address there is Tariq, Tariq, at anthemcp.com. You can contact us. You have phone, email information on our website, some other educational material on the website as well. A book that you can download for free on the website. So take the time if you can to go to the site and look around, download the book. It's written by my partner Ivan and myself, going over the journey and lessons that we learned as we went through it. And then, if you want, you can connect with us through that.
Awesome, Tariq. We certainly appreciate your time today. I will certainly be following you and your future acquisitions. Look forward to talking to you here soon.
Thank you so very much. Appreciate it.